here today with Matthew Reid to talk about the Diverse Income Trust. What is the Trust's investment objective and how is it structured?
Okay, the Diverse Income Trust investment objective is to provide an attractive level of dividends coupled with capital growth over the longer term. It invests primarily in UK quoted companies across a wide range of market capitalisations with a long-term bias to small and mid-cap equities. Now, in terms of borrowings, it can gear up to 15% of net assets. Typically, gearing will be less than this, and is currently about 4% net geared. From an income investor's perspective, it pays quarterly dividends. It pays out the majority of its revenue earnings each year. Currently offers a circa 3.5% yield and is managed by small cap expert Gervais Williams.
Now, DIVI has a substantial allocation to small cap equities. How does that differentiate it from its peers?
Okay, the Diverse Income Trust has been a member of the UK Growth and Income Peer Group since its launch in April 2011. Now, there's been a tendency for members of this peer group to run relatively concentrated portfolio with a strong focus on the top dividend paying stocks in the FTSE 100. Now, does this matter? Well, it caused problems across the peer group when the large or heavyweight financial companies cut their dividends in 2009, and then again in 2010 when BB cut its dividend after the Gulf of Oil Mexico spill. Now, if we look at our first slide, this shows an illustration of the concentration and focus of the UK Growth and Income Peer Group. This is derived from their published top 10 holdings, and if we look at their top 10 holdings, you can see that the average allocation to the top 10 FTSE dividend payers is 23.3% across the peer group, whereas actually Divi has zero allocation to these companies.
Now, the Trust completed its second successful C-share issue back in December. How much was raised and what effect does that have on the shareholders?
Okay, I suppose by way of background, when Divi was launched in April 2011, its initial fundraising raised £50 million, and the aim was to generate a 4% yield on the original capital that was invested. Now, Divi was successful in that objective, and its distinct strategy has proved very popular since, so much so that it's predominantly traded at a premium since launch. Now, both to satisfy this demand and help moderate the premium, the Trust has completed 2 successful C-shares. The second, as you quite rightly mentioned, completed in December, and it raised £31 million. Now, what benefit does this have to existing shareholders? Well, these are twofold, really. The first would be increased liquidity. This is derived primarily from the fact that when the C-shares convert, obviously there'll be additional ordinary shares in the marketplace, but also this is going to take Divi comfortably above the 100 million threshold, which will make it a lot more accessible to a whole range of wealth managers. The second benefit would also be that you're spreading the fixed cost of the Trust over a larger asset base, so this should actually have a positive effect on its ongoing charges going forward.
Now, the boards of Divi and Henderson Fledgling are proposing a merger of the 2 trusts. What impact do you think that's going to have on the shareholders of both trusts?
Well, I think the key thing is this is potentially good news for both parties. If we look at it from Henderson Fledgling investors' perspective to start, first of all, Gervais Williams actually used to manage this trust. He was lead manager of Henderson Fledgling until September 2010 when he left Gartmore. The second thing to consider is that Henderson Fledgling has a hybrid strategy whereby it is 65% indexed against the Fledgling index. The remaining 35%, an active overlay is applied to that, whereby stocks are under or overweighted depending on whether the fund manager more or less favours them. Now, this strategy worked for a long time, but more recently it's not been working. The reason is that when the FTSE Fledgling Index was launched in 2003, it had a market capitalisation about 6.6 billion and about 300 companies. Today, that market capitalisation is close to about 1.6 billion, and there are now 92 companies. What does this mean? Well, it means that actually from Fledgling Trust perspective, to get a neutral weighting, they now need to hold probably nearer 4.7% of a company, whereas previously you needed to hold about 1%. So it means the transactions cost have gone up, and it actually takes longer to replicate the index. So the strategy just isn't working properly, and Henderson Fledgling really needs a new strategy. Now, if we look at this from the perspective of Diverse Income Trust shareholders, once again, actually, you're going to get more assets, you're applying those fixed costs over a larger asset base. Also, you're going to see more ordinary shares once Henderson shares are converted, so once again, improved liquidity. And finally, if we actually look at it from the fund manager's perspective, well, Gervais used to manage this trust, so he's going to be familiar with a lot of the holdings that are in there already. So it's going to be quite a nice fit with the new strategy.
Matthew, thank you for joining us today. And if you'd like any more information, please do visit the Edison website.